Hi, this is Doug Skinner from AFS. I appreciate you watching this short video. Today, we wanted to touch on some of the major challenges the banks are dealing with and look at some recent data reflecting those challenges. And we will also look at what the future regulatory implications of all this might be and how that could impact the industry as well. Now, the month of March represented a period of unprecedented interest rate volatility and global banking instability. Fortunately, the problems facing the industry are not asset quality related, nor are they issues of capital adequacy. Instead, what has happened is the rise in interest rates over the past year, combined with the recent failure of two high profile banks, has led to some challenges, which I've listed here. Deposit runoff has been an issue for the first time in many years, which for many appears to have stabilized, but there remain some pockets of instability. The rising cost of funds. The Fed started raising rates about a year ago, and banks, they typically always recalibrate the pricing of their assets in lockstep with those increases. But on the other hand, adjustments to deposit pricing often lag behind. But they're catching up now, and it's squeezing their net interest margins. How high will the Fed raise rates to fight inflation before pausing and actually starting to cut rates? Usually, when there's some sort of crisis, the Fed pauses, if not cuts interest rates. But last month, they actually continued to raise rates despite the regional banking crisis, suggesting they're more concerned about getting inflation under control and stabilizing prices. There are real concerns about a contraction in lending well before the failures of Silicon Valley Bank and Signature Bank in March. Banks had already been tightening their underwriting standards and reporting a cooling in business demand. Now, we get another update from the Fed's Senior Loan Officer Survey on lending conditions next month, and a continuation of that trend seems likely. And then what will be the regulatory response to all this? We'll certainly have some response, and we'll have more on that at the end of the video. One thing we're watching closely is the trend in bank deposits. Deposits are banks' primary source of funding for lending. So if deposit balances are falling, banks may not be able to meet their loan growth plans. And they've definitely been dropping by nearly $1 trillion over the past year. Much of that drop has come just in the past month as customers were spooked by the two bank failures. Depositors have pulled funds from banks in part over fears about their safety. And while those safety concerns are largely misplaced, they are also leaving because bank deposit rates are still below money market rates and short-term treasury yields. Much of the deposit outflow has gone to money market funds and that invest in U.S. government securities and repos. So in effect, customers are trading off FDIC insurance for the full faith and credit of the U.S. government. So the question everyone is asking is, will this all lead to a contraction in lending, which is always bad for the economy? Honestly, it's probably too early to say. We're starting to hear from the banks right now on their first quarter earnings calls, and they will update their guidance for loan and deposit growth for the remainder of the year. This chart shows the weekly commercial growth reported to the Fed. You saw a brief spike the week of March 15th. That is probably due in some part to the two bank failures that prior weekend. And in response, corporations and banks stocked up on liquidity to deal with the market turmoil at that time. But with rates having risen 500 basis points in relatively short order, deposits falling, and lingering concerns about liquidity, it stands to reason that credit conditions will continue to tighten and weigh on lending and overall economic activity. So on the heels of these bank failures, what can we expect from the regulators? Several regulatory officials have already testified at some recent hearings, so we're starting to get a pretty good view into what they'll look at. One area will certainly be the future treatment of unrealized losses in regulatory capital. Today, only the very largest bank holding companies, those with greater than $700 billion in assets, have to include unrealized losses on the available for sale portfolio in their regulatory capital figure. There's a very good chance that the asset size floor drops substantially for that requirement, potentially to include banks at $100 billion and up. We can expect Congress to look at rolling back some or all of the 2019 amendments that were made to the Dodd-Frank Act. Those amendments had actually raised the asset threshold at the time for some of the original Dodd-Frank rules on things like liquidity requirements, stress testing, and capital buffers. And there will be calls to roll back those changes. We can expect a renewed focus on asset liability and interest rate risk management in bank examinations. Now, that is not a new phenomenon by any means, but it will certainly be a renewed point of emphasis. And the larger banks can expect a special assessment to replenish the FDIC for the losses they incurred in the bank failures. So it's going to be an interesting second half of the year for the banking industry, and we'll continue to follow it and keep you updated. Thank you for your time. Have a good day, and give us a call or send us an email if you have any questions.